Good afternoon, everyone, and thank you for joining the MIGO Opportunities Investor Update webinar. The format of today's call will be a presentation from the fund manager, Nick Greenwood, followed by Q&A, and you may ask questions at any point during the presentation by using the Q&A button at the bottom of your screen. For those maybe less familiar with the strategy, MIGO seeks to exploit mispricings in the closed-end fund world. In practice, this means that the team are seeking to identify discounted investment trusts where they are bullish on the underlying asset class and NAV returns, but they also believe that there's a catalyst and/or special situation that will narrow the current share price discount to NAV. It's this powerful combination of a rising NAV and a narrowing discount that can lead to explosive returns for this strategy. And MIGO's performance history is testament to this. In 2016, we saw discounts widen following the Brexit referendum, and the following year, MIGO returned 36% in share price terms. In 2020, following the COVID crash, discounts widened again, albeit momentarily, and MIGO returned 25% the following year. As we sit today, the average discount on the investment trust sector is wider than at both those 2 points, and the team believe that the seeds for the next run are in the current portfolio. With that, I will hand over to Nick to go into further detail.
Oh, thanks so much, Will. I'm looking at the guest list. I think most people know what MIGO is, and what I would term perhaps the regulars. But it's probably worth just me running through a few slides just for those of you that are new to MIGO about what it is and what it does. I'm going to skip quite a few slides because I think probably we're at quite an interesting time in markets. So I will spend a bit more time on some of the things that have gone, some of the things that have arrived recently, and trying to do a bit of stock specific stuff rather than running through the slides that many of you may have seen before. As Will says, we're looking for overlooked and unloved situations in what's now a highly diverse and inefficiently priced sector. Special situations where we can see a catalyst for change. And remembering that an investment trust share price is purely decided by the balance of supply and demand, and those things can fly around all over the place. Slide that hopefully you can see in front of you, a little bit on the process. We're looking at stuff that's trading at a discount simplistically, but in reality, quite often, especially as the sector has become a home for alternative assets, the discount may well, in many cases, be in the underlying portfolio rather than in the investment trust share price. Historically, we haven't tended to own the large trusts because many people use MIGO as a subcontraction vehicle and may well be, in the industry themselves. And most MIGO shareholders are able to take a view on the large trusts themselves. They're really looking for us to be getting involved in the small, more difficult things and things that are overlooked and unloved. We're not going to buy discounts simply, or buy trusts simply because they're on a wide discount. Because we have to like the asset class. We've got to be quite bullish about what's in the portfolio as well, and therefore a lot of things that trade on big discounts will drop out. And in the example here, we've used for many years fixed income, but this slide may have to be revised because we're feeling a little less bearish on fixed income than we have done over the last number of years. Do we have the confidence in the NAV? I mean, we'll touch on this later, but NAVs in the alternative world are subjective. I've been in the markets for many, many years, well over 40 years, and I've seen what happens to leverage, and I felt the pain in my younger times. So we describe ourselves as allergic to leverage. I think, and incredibly importantly, there has to be a catalyst because many trusts can trade on wide discounts for years, and quite often many of the family controlled trusts would disappear at that stage of the process, leaving us with quite a short list. And we say there, we're trying to buy £1 worth of assets for as little as 70p. That's almost exactly the figure at the moment. This slide really cuts to the chase, and it's a very simplistic slide, and it's modelled on a situation we had in Ecofin a few years back. But the important thing to bear in mind is that both those lines have the same underlying portfolio. If you spot an unloved asset class and you get it right, in the example there, you can see that the assets went up 40% in value. But if you can pick it up in owned by an unloved and overlooked investment trust trading on a 30-odd discount, and that discount disappears, as Will says, the returns can be explosive, and in that example, you double your money. Important point though, dark blue line, light blue line, same underlying portfolio, and that does cut to the chase of what we're looking for and what we do. Cutting through a few of these slides that you've seen before, I'll linger on that one a little bit. We do sometimes describe our style as watching paint dry. We're quite happy to invest in a situation even if we know that catalyst might be a couple of years down the line. As long as we can identify it, we're quite happy to sit there. And shareholders are used to seeing MIGO share price go sideways for long periods of time, and then periods of intense activity. We'll touch on the reasons for this next slide later on, but there's very low correlation, it seems these days, between the trust and the equity markets. And you'll see as we travel on that the sector has changed. 5 years ago, most investment trusts tended to be long only equity funds. Increasingly these days, it's exposure to other, and a wide diversity of newer types of alternative asset classes. And inevitably, the portfolio is, we'll touch on it later, but there's less and less equity exposure in the portfolio as the sector continues to change. Get on some of the other regular slides. I think it's important, just to give this example, and I said that the sector is moving to being home for alternatives, and this is an old slide, and we've seen it many times before, but it just highlights how subjective the net asset values are on alternatives. And the opportunity comes because, as I just said, the sector used to be a home for most equity funds, or most investment trusts used to be long only equity funds. When you're working out the net asset value of those, you run your Bloomberg, you produce a figure at the end of the day, and you publish that, and that's a good call for what the portfolio is actually worth. But once you move away from the equity market, it does become subjective. The trees are an example of an investment trust that owned forests on the south coast of, or South Island of New Zealand. The Chinese banned the felling of natural timber. The NAV would have been completely transformed by that, because New Zealand is an ideal place to export to China from. Around that time, ballpark figure, the NAV would have been about 50p. The share price was 40, but the markets tend to take NAVs as verbatim, even though which because they're used to the portfolio or investment trust being equity funds. And therefore the market takes those figures as verbatim. This particular case, we think that the NAV probably rose from around 50 to 65. The share price stayed rooted at 40. The market was still using that official NAV as for the basis of decisions. And in the end, an Australian hedge fund took the bid for the entire company at 65, which was at 52 rather. A nice uplift, but well short of the 65p we felt it might have been worth. So, more topical example: flats in Berlin. There, the portfolio or investment trust was launched as a rental landlord. Increasingly, they're splitting up the flats or the blocks into individual flats, selling into the private market, which gets you quite a big premium. But of course, nothing wrong with the methodology. It's just a bit stale. The trust was set up as a rental landlord, and the NAV uses the rental figures, but that obviously underestimates what we feel we could actually sell the portfolio for. And that means that the net asset value understates the true value of the portfolio in that situation. And then, it's just a couple of examples of the day job trying to work out, what the portfolios are actually worth. This one's a relatively new slide, and it's quite important because it just highlights asset classes that are either in the portfolio at the moment or have recently been in the portfolio. And you can see that a lot of these wouldn't be possible to run these as an open-ended fund. Very few of these asset classes are actually, long-only equity funds. For example, Microcap UK is, India is, there's a little bit, some of Vietnam is, mid-cap Japan is, but other things like Berlin residential, private equity in Georgia, flats in Macau, shipping, corporate mortgages. It'd be very difficult to run these as open-ended funds. So you've got a vast amount of diversification through MIGO that you just can't get elsewhere. And also because you go back 5 years when it was largely equity funds, there was a lot of correlation with equities. We might be deciding that Japanese small caps were unloved and buying into it and financing it from large caps in Europe, which are done well. But at the end of the day, a lot of equity markets tend to move more in lockstep. Here, there's always something that's going to be hot, and there's always something that's going to be cold, that provide opportunities to move around. And a good example from last year, shipping we sold out of because we just felt it just got as good as it was going to get. Everything was going perfectly well. Shipping rates were through the roof. Demand was great. Supply of ships was relatively limited. But it's a viciously cyclical business, and we just took the view that things were going so well that it was unlikely to get better. And we moved across and reinvested the proceeds in biotechnology, which had a tough time and had just suffered from the rotation out of growth into value. And there was a lot of concern about the possibility of pricing controls in the States. So it's just an example of one asset class that was massively in favour, and taking those profits and then moving into something that was overlooked and unloved. And overlooked and unloved is what we're looking for. I think looking at entrants and exits, we'll run on some of the ones that are on the screen, but examples of things that have gone into the portfolio. Last time I sat down on one of these, somebody had told me that I would be owning a aircraft leasing trust. I would be very, very surprised. But things changed dramatically in a short period of time, and go back not that many months. Some of these aircraft leasing trusts, their planes were sat in the desert gathering dust. Since then, we've had a dramatic increase in demand for air travel. And in the case of the trust that we've actually bought into, a lot of their planes are operated by Emirates, and they are 380s, which were expected to be phased out relatively quickly. There have been the new wide-body fleet that Emirates was hoping to replace the A380s with have had delivery problems and may no longer arrive. And they have said that there's a good chance that they'll run these 380s into the mid-2030s. So you've gone from a period of very limited revenue to quite a high amount of revenue running for a longer period of time. Looking at the situation, shares were down to around about 30p. I mean, they had been lower than that before the changes, but looking at the rest of the trust life, back of the envelope calculations, there's probably 40 pence of dividends and maybe 20 pence of residual asset value to come. So it is a situation, to go back to the comment about watching paint dry, that we're picking up stock at 30p, and our central view is that 3 or 4 years down the line, or 4 years down the line, our best guess is that the value would be closer to 60. So watching paint dry, but those sorts of returns, if you can turn 30 into 60, that is an attractive option. We've revisited the Japanese activist funds. I mean, I've been told so many times over the years that Japan is changing, corporate governance in Japan is improving, and have been, on many occasions disappointed. And it's probably an example where experience can be a hindrance. If something's worked in a particular way for 30 or 40 years, you tend to stick with that. But it's quite noticeable that the activist funds have, significantly outperformed their peers. Not that we missed that much, because the yen has been incredibly weak. And also smaller and mid-cap stocks in Japan are very lowly rated relative to the world. So we've got a situation there of the underlying equities being deeply discounted, but with a catalyst for change, and that activism seems to be making some progress. the typical US style asset stripping approaches will still be rejected, but a pragmatic approach, will be listened to. And there was an opportunity to buy Nippon Active Value at a very deep discount. What tends to happen is that in relatively illiquid markets, if you get a committed seller, then share prices can fall quite a long way to quite a steep discount. And if you can respond quickly, there are the opportunities to pick up lines of stock at very cheap levels. And that was one of the opportunities that's presented itself in recent months. VPC specialty lending, again, it's performed very well. It's a lender to SMEs in the States, but the problem it has, it's based in Chicago, and it's very difficult to get a following if you haven't got a marketing operation over here. So despite the fact that it's performed well, it's a fairly complex story. So it hasn't been able to generate a following, and a bit like Nippon Active Value, there was some committed selling around, which drove the discount in that particular case. I think that we managed to pick up a line of stock at 36% discount. Since then, it's been approached by a couple of activists itself. A couple of hedge funds have approached it, looking for them to tender and release value to shareholders. And again, there's some, it's such a diverse sector now. There are so many opportunities out there that a lot of these trusts have just got lost. And if you are looking for the overlooked and the unloved, and you're trolling this area, sometimes these positions or situations can present themselves. I mean, certainly, I spent this morning going through the paperwork for the Investment Trust of the Year awards, and VPC specialty lending is by far the best performer in its corner of the market, yet it trades on the biggest discount. So those are some of the new names that have gone into the portfolio in recent weeks and months. Looking at some of the departures, we touched on shipping, and that was Tufton Oceanic. Strategic Equity Capital is a good fund, but we were just concerned about UK small caps in general, and that we're still seeing the aftershocks of the pandemic and the war. And looking at the screens in the morning, there seems to be one or two small caps every day blowing up for reasons that I didn't foresee. And if we're looking at a recession coming, we had sort of 7 or 8% in UK small caps. We still like the sector long term because it's they're inefficient investment trusts focusing on inefficient corners of the market. But this is one situation where it was just a macro call to aggressively reduce our exposure to UK small caps. Probably the most significant transaction over recent months was the disposal of Alpha Real, which was actually 5% of the portfolio. We'd bought these shares in the middle of the global financial crisis at 20p, and we exited them at 175p. Partly, interest rates were going to go one way, and therefore, we had quite a bit of exposure to property, and this was the biggest property exposure we had in the portfolio. So we took the opportunity to sell it. Partly, we were slightly concerned in that, historically this has been an owner of property. It transitioned, or was planning to transition, to being a lender on property, and that never really took place. There was a number of transactions took place, but there were also some credit losses, which was a bit of a concern coming so soon after the change of strategy. And it was sort of morphing back into owning property again. So it was slightly concerning that really since the advent of COVID, the trust has sort of lost its way a little bit, and therefore we disposed of the position. It was via a tender. I mean, the shares have got out to a 42% discount at one point, and tender was 70%, but it was a very significant uplift from what we were carrying them at. And another one, just to mention, Third Point, again, a very successful investment for us. We bought into it just in the aftermath of the COVID panic. Basically, it was an attractive turnaround situation on a trading on a 30% discount, and the shares tightened up. The management managed to turn the situation around, and the discount narrowed to 12%, and therefore achieved everything that we were looking for, and therefore it was a good time to move on. The other concern was that it had exposure to quite a few early stage businesses in the States that had IPO'd, such as Greenwood, which is a electric motors business. These things, some of these things have been trading on fairly extreme levels, and therefore we were slightly concerned about that as well, and therefore we exited Third Point. So just a few examples, and just gives a flavour of what it is, and some real life examples of the investment process in action. This is probably one of the most important slides in the pack. That figure, I think we've never quite cracked 30. I think after the presentation pack was put together, I think we probably did see the average discount drift out to 30. This slide, normally in more normal conditions, although we haven't seen normal conditions, it seems, for a long period of time, more typically 15 to 20%. So when we talk about seeking to buy stuff at sort of 70 pence in the pound, we're pretty well there. And you can see with the discounts getting that wide, we've been dodging bullets really this year, in that if you have a portfolio of trust and discounts widen fairly dramatically, then it is a bit of a struggle. So we've been pretty defensive so far this year, and understanding that if you're catching the double whammy in reverse, that can be quite painful. So we're still sat with about 15% in cash. That holding at the top there, Dunedin Enterprise, is a trust in orderly wind down. Although it trades at a discount, half of it is in cash, waiting to just be handed back to shareholders at NAV. So that takes a look through cash to about 18, and we have borrowing facilities of about 7 as well. So it's a tough time at the moment for smaller investment trusts such as this, because there is quite a transition away from the wealth management chains. The private client stockbrokers were the natural buyers until recent years. They've mainly merged into very large organisations that really run pots of money that are so big that they need hundreds of millions of pounds of stock in investment trusts to move the needle. Therefore, in recent years, it's less practical for them to actually be involved in the investment trust market. But at the same time, the self-directed investor has got more interested. And really, up until the invasion of Ukraine, we were seeing a situation where the trust market was in quite a nice equilibrium as the wealth management chains chipped away at their existing holdings. Those shares have found themselves, with the self-directed investor sat on platforms like AJ Bell and Interactive Investor and Hargreaves Lansdown. But what we've seen post the invasion is the appetite for risk completely evaporating, and that the self-directed investor is sat on the sidelines, but we still have the drip selling coming from the wealth management chains. So the situation we've got is in most trusts quite low levels of turnover, but that turnover is biased to selling. The market makers don't want to keep building up inventory, and therefore share prices and therefore widening discounts have been the result of this imbalance. And there will be a time when people feel more optimistic, and where we've sat really on a market view is that we felt that the rising in interest rates would have a much more brutal effect than investors or the more markets felt, but the whole process will be relatively short-lived. And obviously, we didn't predict what's been happening with the UK government, but it does flag the fact that there's so much debt in the system that very small rate rises in interest rates historically will have a much bigger effect this time. For much of my career, a 75 basis point rise in interest rates wouldn't have that much effect, but it certainly does have an effect now, because very quickly, so much debt in the system, the servicing of debt, whether that be individuals or governments or companies, rise sharply. And therefore, it won't take that many interest rate rises to actually produce the desired effect, albeit it will take a while to work its way through the system. Just looking at those, some of those trusts discounts have widened fairly dramatically since. Baker Steel has managed to touch 50% in recent days, and we have actually nibbled that one. But it does highlight the situation we have at the moment, in that if the natural buyers are sitting on the sidelines, you've got a bit of selling. When you get a committed seller coming into one of these markets, then share prices can move a long way very, very quickly. So there are plenty of opportunities around at the moment. If we can be nimble, and we are sitting on cash. Property stocks, you can see, Phoenix Free Deutschland trading on a 42 discount. I think with property, until there is some certainty over the cost of capital, you just have, and the markets can't cope with uncertainty. You just get very, very weak share prices. Hopefully, we'll have some certainty very soon. And even if it's bad certainty, at least analysts can get their slide rules out and work out the true value of some of these things. And inevitably, once uncertainty is cleared, then share prices bounce, even in the event of bad news being confirmed. I think I've probably covered all sorts of the outlook. I think a couple of things just to flag before we get on to the questions and the more interesting stuff. The sector's probably been turned upside down by rising rates, and that a lot of the areas that we haven't been looking at in the past, because they've been very, very popular and trading at premiums, things like renewables, infrastructure, song rights, for example. A lot of these trusts have really been bought in a period of yield starvation, because at the beginning of the year, gilt might yield you 1. I think in recent days, they shorter dated gilts have touched 4.5, at a time when maybe a stock like Hickel, for example, started the year at 4.7% yield, now slightly over 5. If many investors have bought these purely to get the income as the primary reason for trading these shares, then they're not going to be bouncing back particularly fast in the recent falls, and there might have to be a little bit more of a spread. So I think that sort of area, there's going to be some disappointment, and there are going to be a lot of opportunities throwing themselves up in that particular area, which is unusual. So the portfolio could look quite different in a year's time from what it looks like at the moment, and it has been quite a sea change, because there is a hell of a lot of paper out in those sectors, and if investors are sort of staying away from that sector, there are easier ways of getting the income. Gilts giving you an attractive yield now. We might see those sectors trading at discounts, and of course, if there are a few committed sellers out there, then prices could get very interesting. Also, they've got to cope with a lack of clarity on power prices and all sorts of political risks as well. So that's an area we'll be doing a lot of work going forward. So that's a quick run through. Hopefully that'll chuck over a few questions. I think that was 30 minutes, so bang on time. So back to you, Will.
Nick, thanks. Yeah, there's a good few questions come in, a couple of which you've covered, but maybe if I start with this one, what do you see as the catalyst to normalize discount levels?
Sentiment and removal of uncertainty, and the return of the self-directed investor, and they do understand the sector. I mean, I sort of term it the money week reader. It doesn't, and also the point is that a lot of these discounts are very wide on very, very small levels of turnover, so it doesn't take much of an improvement in sentiment and just a modest amount of buying, and you can see some of those 46 discounts quickly go into 18 at a time when the underlying assets are bouncing. So you go back to that slide 6. It doesn't take much. Just a very improvement in sentiment, a removal of the uncertainty. Once people know the cost of capital, even if it's much higher than it's been in the past, that uncertainty, you then have the certainty, and therefore you can then actually work out what something's worth. And of course, markets can't cope with uncertainty, so things will always get too cheap when uncertainty abounds. It's a very long answer for a simple question.
Thank you. The discount on MIGO itself has remained very stable. What is the reason for this?
We we tend to buy in and to issue. So in our case, and if you look at, it tends to be the number of shares in issue tends to be the thing that moves up and down rather than the discount. So if you look at MIGO during 2022 first quarter, we were steadily issuing new shares. Second quarter, we were buying back because markets were having a tough time and there were plenty of sellers around, and therefore bought a lot of shares back. More recently, we've been issuing again. And it is quite unusual, actually, because if you look at the sector as a whole, there aren't many trusts that are sort of issuing and redeeming sort of in short order. Most trusts are either serial issuers or serial redeemers.
How have you taken advantage of the closed-end protection from outflows during this year?
Yeah, I mean, I think, highlighted there that a lot of these moves on small amounts of turnover, and prices moving around, and a lot of these trusts are difficult to trade, and we add quite a lot of value in the trading. It'd be very difficult to do what we do in an open-ended format. We have an open-ended fund, but obviously you have to have a much longer list. You've got to know where a few £1 million are coming from. So, for example, with Baker Steel, for example, ending up on a 50 discount, publish an NAV of 81, and then you can buy the shares at, brand new NAV at 81, and you can buy the shares at 42. You could only deal in those conditions if you were a buyer, and if you were running, an open-ended fund, you'd need a much smaller weighting. So you can get a lot more conviction into this portfolio with the closed-ended protection. It's an incredibly important point because there aren't that many people that can exploit this in the same way we do. I mean, we do own the Baker Steel in the OIC, but obviously it's a much smaller weighting. It's a frequently overlooked point that actually is that the protection from inflows and outflows in a market like this gives you a big advantage over other investors.
Thank you. Does ESG disillusionment offer the potential for discount narrowing in certain areas which it has been fashionable to avoid in recent years on ESG grounds?
Yeah, I think that it's all tied up really with a lot of the renewables and some of the yield stocks. So it's difficult to know where yield disappointment and ESG disappointment start and finish. I think that whole area there are going to be opportunities, and that's actually where we're doing most of the work at the moment, and going to look at a lot of new names that we haven't spent much time with in the past.
Thank you. Is the proposed sale of Brompton changing the outlook for New Star Trust?
Don't think so. We look at that one as the reason for the ownership is inheritance tax planning for Mr. Duffield, and I suspect that the chain of events will be that some years, hopefully down the line, when Mr. Duffield moves on, the valuation for probate will be at a 58 discount or whatever it's trading. Actually, it's quite tight at the moment. It's trading around a 30-odd discount, which is tighter than it has been in the past. But the fund will be unitized, and beneficiaries would likely to be selling the units that they get at 100% of NAV rather than the 70% of NAV or whatever that they trade on as an investment trust. So yes, that's probably one of the woolliest ones in the portfolio. We bought it many years ago in the middle of the global financial crisis very cheaply. I think it was something like a 58 discount, and what you have there is, for 40 odd pence in the pound, you've got a perfectly competent fund working for you. Even at the moment, like many of these situations, you pay 70 pence in the pound, but you've got a pound working for you. So it's. But I don't. Coming back to the original question, I don't see much change coming from the Brompton transaction.
Music and space attractive to you yet?
No, only that we're starting to do the work, and I did have the opportunity. Unfortunately, Serafin is holding meetings today, which clash with this. But I suspect that that's one that could be very interesting. What so often happens is that an investment trust gets launched when a sector is hot. That's one of the weaknesses of the closed-ended structure, is that you can only launch them when you have to come up with all the money on sort of day one, where you can't sort of see the small, where you can see the small icon and it can build. Therefore, the ones that tend to get away are asset classes that are hot, which is normally not the time to be buying into it. And you can imagine something like Serafin spending a couple of years building up the portfolio. I mean, it's probably not a good example, but a general comment, maybe not about Serafin, but quite often if you spend a couple of years building the portfolio, people get bored after a couple of years. They bought into something, he hasn't really done very much. But just at the time when all the capital has been sunk, the work has been done, people get bored and move on, and the thing trades on a big discount. And it's normally at that point, a couple of years down the line, that some interesting opportunities present themselves. So we'll look at Seraphim on that basis, because that could well be the case in that particular one. Songwrites, we looked at them early, and we often look at the new IPOs, but they weren't very forthcoming with information. They kept basically saying, when you're asking for some numbers, or they kept saying, well, the talent get quite sensitive. The talent wouldn't like you to know this, etc., etc. So if you don't know the answers, you can't really make a decision. But it does feel as though the market has fallen quickly out of love with these. Also, they're being put under pressure because they've had to do a refi at quite a high interest rate. And obviously, as the earlier comment, that gilt yields, have been as much as 4 or 5% in recent weeks. A lot of people take the view, well, we'll take a much simpler way of getting the income, because investors have been starved of income in recent years, and therefore that's led to a proliferation of products like Song and Roundhill and many others. So if that demand is disappearing, or that sort of demand is disappearing, then you may get some very big discounts like that. So again, we will be looking at the Songwrites funds and to see whether that's something we ought to be getting involved in.
Thank you. Whilst yield is not a primary aim for MIGO, a lot of opportunities recently have become much more attractive in high-yielding sectors like REITs, renewables, and debt funds. Has the underlying yield on the trust portfolio been on the rise, or might it do so?
Yes, very much so. It's been on the rise, and getting back to my earlier comments and the sorts of stuff we're going to be looking at, and the area where we think the opportunity is going to be coming. Yes, I mean we would expect the portfolio to yield a lot more going forward than it does at the moment, and it yields a lot more at the moment than it has done historically, to the extent we even had to pay a modest dividend to keep our investment trust status.
Do you think we might see some takeovers in the trust sector with these levels of discounts?
I think we probably will see some, but it's always disappointing that you don't see more in this environment. Mind you, you'll probably see boards putting up the white flag. We saw US Solar, for example, which had been struggling, took a while to get the money invested. Yeah, I mean, and they're just I think just going to wind down. But yeah, I think other boards in that situation might be receptive to a takeover. So yeah, maybe we'll be surprised. Scrutiny is much more than it's been in the past. So again, I've been disappointed in the past when we've had markets like we have at the moment. There've been fewer takeovers, but just thinking it through, maybe I'll be pleasantly surprised this time around. There's certainly the opportunity for plenty anyway.
Any opportunities in fast growth stocks yet, Scottish mortgage type things, or still on the early side there?
Probably slightly early, but yeah, I mean, they've been better. We keep an eye on Chrysalis. It's one that we used to own. In fact, we still got a few shares, but it doesn't amount to much now. But they're probably it had the fall on price. But there are a lot, there will be a lot of people wanting to get out, either because they don't want it in client portfolios anymore because it's fallen so far, or people like Jupiter, for example, having the portfolios, and they need to reduce the exposure to it because it's becoming too large a part of the portfolio. So you can see plenty of sellers there, which might, so in price terms we might be around there, but it just might take a bit of turn to get the recovery in the prices moving.
Any view on how your portfolio in general would fare were we to see a Fed pivot in policy?
What we're invested in would rise very, very sharply. I mean, as I said, there is a lot of these very wide discounts have come about from very modest amounts of selling. Therefore, it wouldn't take much buying for them to move sharply higher very, very quickly. If it happened too quickly, that would be slightly disappointed because obviously on a look-through basis, we're only 82% invested. We are buying rather than selling, but it's when opportunities arrive. So it would be nice if the pivot was a few weeks or months away and we were more fully invested.
Thank you. Do you have any general preference for dividends versus buybacks at this time?
No, dividends and buybacks are very different in the investment trust world, and maybe not so different if you're looking at US equities. Yeah, I mean the thing with buybacks, I mean because we're sort of capital growth, and therefore buyback can with this extreme levels of discounts we've got at the moment would ratchet up NAVs, but also remove overhangs. So in these conditions, buybacks would be more useful for us.
How are you trading currently when you have or can access similar positions with different volatility profiles? And the examples of Geiger counter versus yellow cake, Georgia Cat versus Bank of Georgia.
Yeah, Bank of Georgia would fall outside of our universe. So we can only buy into Bank of Georgia. On the uranium stocks, we own the two separate ones because they've got very different return profiles. Yellow cake actually owns the physical metal and will be much less volatile. Where Geiger counter has mines, and in many cases those mines are in the latter stages of development, and therefore you've got a lot of operational gearing in there on top. So the return profiles, even though they're both uranium related, return profiles from those will be very, very different. So it's quite good to have both to even that out.
Being invested in sterling trusts, how does currency come into play in the investment process?
We can hedge currencies. We haven't for some time. I mean, at the moment, I mean, sterling's been very weak, and therefore that's quite pleasant if you're unhedged. It's a global fund expressed in sterling. The one we've been looking at obviously is the yen, and therefore we've got we look at the activist funds. We've got very cheap underlying equities, but also very, very cheap currency because of the policy of fixing their bond yields. So it's one of the things. It's one of the macro things you look at, and I think yen is the one that's sort of most involved in current thinking in a particular situation.
How has the market reacted in relation to your past experience of bear markets? Are there any noticeable differences?
I think all markets are different. This feels more like probably the mid-70s. But I sometimes think it's a trap that so many people talk about what's happened in the past in markets, and I prefer to think of each one as a different experience. So yeah, I've been through many bear markets, and they're all very, very different. And yeah, I don't think this one will be a complete rerun of 73, 74, etc. Which I wasn't quite old enough to be working, but I did start in the late 70s, so I do remember it. But that's probably got the most commonality.
Will negative UK sentiment hang over the investment trust universe, or will the underlying assets be the main driver to a return to normality and tighter discounts?
I think the main driver will probably be the move in discounts, because it just takes such a modest improvement in sentiment to get that moving. So yeah, I think that. But at that time, you would expect the underlying assets to be rising as well. So you get this very powerful combination. But yeah, I mean, it's the discounts are there on very small amounts of turnover. So in many cases, it may not be much more needed than a few sort of high net worth individuals buying PA.
Thank you. That concludes all the questions we've had, Nick. I don't know if you had any final remarks. Otherwise, I'd just like to thank everyone for joining this afternoon. And if you do have any further questions, we can be reached at distribution@frostrow.com. Nick, was there anything else?
Not that I can think of. As soon as we hang up, there will be about 23 different things that I thought I should have mentioned. But at the moment, the mind is completely blank.
No problem. With that, I'd like to just thank everyone again. And yeah, if you do have any questions, please reach out. Thanks, Nick.
A pleasure.